How can retail investors invest in private equity? Think private equity is only for billionaires or Wall Street insiders? Well, think again. I'll show you how everyday investors can get inside access to private equity deals and why it might be one of the smartest moves you ever make. Most people don't realize that some of the best real estate or business deals are locked away in private equity. What if I told you retail investors do have access to these private equity deals? Well, in this video, I'm going to show you how. If you want access to high growth investment opportunities that aren't on the stock market, then stick around. I'll break down for you exactly how retail investors can invest in private equity. By the end of this video, you'll know exactly how retail investors can invest in private equity, what options are available for investments, and how to avoid the most common pitfalls when investing with private equity. So what is private equity and why should retail investors care? When I say retail investors, I mean the average investor like you and me, not institutions or pension funds or sovereign wealth funds. Private equity refers to real estate, buying businesses, investing in funds that aren't on the stock market. These deals often have higher returns but require more due diligence. Historically, access to these types of investment vehicles were only available to ultra-wealthy individuals or institutions. But that's changing. The number one myth: you have to be an accredited investor to invest in private equity funds. Now, this is true. Many private equity firms do require their investors to be accredited, meaning you have $1 million of net worth, excluding your primary residence equity in your home, or you make at least $200,000 a year for the last 2 years on your salary. And if you're married, that is a $300,000 number. That is what an accredited investor status is. But there are alternative paths for retail investors that aren't accredited. These are called Reg A funds. This allows a private equity firm to raise capital from non-accredited investors. Most commonly, you'll find these funds on crowdfunding platforms. These crowdfunding platforms are Fundrise, CrowdStreet, Realty Mogul. These are some examples. Other options are real estate investment trusts or private equity funds that have the Regulation A status. So let's compare the three between crowdfunding, real estate investment trusts, and private sponsors that have a fund open to accredited investors or non-accredited investors. Investment type: crowdfunding platforms. Pros: low investment minimums, accessible to non-accredited investors, you get diversified looking deals, and you get passive investing where you're hands off. The cons: high fees, limited control, they're illiquid, and there's been challenges with transparency. Investors do not really know what's going on with these types of investments, and they've had a little bit of a bad track record over the last few years. Next, real estate investment trusts. Benefits of real estate investment trusts are liquidity. They are on the public market, so you can buy and sell shares when you need to. You get a diversified portfolio. You get consistent dividends in passive income. There's a very low barrier to entry, and you can go on any investment brokerage account website and buy a share of a REIT. The cons: stock market volatility. Your investment is directly correlated to how the stock market's performing. There's typically lower returns, around 2, 3, 4% on the dividend yield. There are no tax advantages with REIT investing. And ultimately, you get no control and you can't talk to the decision maker. It's a publicly traded company. Private sponsors. These include real estate partnerships, syndications, and real estate funds. Here at Patriot Holdings, this is how we raise capital for our investments. Pros: higher returns. There are tax benefits with the investment. Typically, you get direct access to the sponsor and you can talk to a decision maker. Ideally, there's an alignment of interest where the sponsor or the general partner is investing alongside the other investors. The cons: high minimum investments, typically $50,000 to $100,000 minimum. These partnership or funds have illiquidity. It typically takes 5 years or more for the fund to mature or the deal to mature. These partnerships or funds require accreditation restrictions. You must be an accredited investor to invest in them. And lastly, the sponsor risk. The person that's running the transaction can ruin it or improve it. You need to be very diligent about who you choose as an investment sponsor or partner in your real estate investments. So as a retail investor, what investment works for you? Let's go over crowdfunding platforms. Quick summary. They're great for small investors that are looking to diversify and to start to track some of their real estate investments and see how private equity investments perform. The bad side of things, no transparency and high fees. These are going to affect your returns and typically not be the best deals. Illiquidity. In these crowdfunding platforms, your capital is typically tied up for 5+ years. Next, real estate investment trusts. These are the best for liquidity. You can buy and sell shares at any given moment, and if you want your capital out of a deal, that would be the right deal for you. And if you would like to get quick access to your capital, then a public REIT would be right for you. You can get liquidity immediately. They are more volatile and they are affected by stock market changes. They're less tax efficient. In a REIT, you get a dividend, not a distribution, and then that dividend is taxed at ordinary income rates. You do not get any depreciation or tax losses when you invest in a REIT. Lastly, private sponsors and real estate partnerships or funds. Typically, these investments have higher returns than traditional market investments like the stock market. Plus, you have access to a decision maker, so you can get your questions answered when you have one. They typically require a higher investment, $50,000 to $250,000 plus. These investments are illiquid. This is one of the downsides of real estate. It would be a minimum of 3 to 10 years before you'd have the availability of your capital back. So if you're thinking about investing in a real estate partnership or syndication, here are the 4 things that you should check for when making the investment. Number 1, is there an alignment of interest with the general partner or the sponsor? Meaning, does that person have hard cash invested in the transaction alongside you? This is a great gut check. If they believe in the investment, they're going to put their hard-earned money up along with you to go buy it. Also, do they have their credit at stake? Is the financing recourse or non-recourse? If their credit is on the line and they had to personally guarantee the note, many times they're going to be very committed to making that investment successful because they can't afford a foreclosure on their record. Secondly, do they communicate frequently and often? Ask for some of their older investment reports. That way you can see the communication and the cadence of that communication. Traditionally, quarterly is at least the minimum that investment sponsors should be updating their investors. 3, hands-on management. Are they actively managing the asset or are they just handing it off to someone else? Is that general partner in the weeds? Do they know how to manage the asset and make the improvements in the property? If they don't, be careful. Number 4, who's getting the tax benefits? In private partnerships or private fund syndications, the limited partner typically will get the majority of the tax benefits, meaning the depreciation that will flow through from the asset to the partnership. So check with your investment sponsor or general partner if the limited partner gets the bulk of the tax losses, which is beneficial for the limited partner so they can defer paying tax and get a better return on their investment because of that tax advantage. So to sum it up, the risks involved with private equity investing. Number 1, illiquidity. I've said it many times, you do not have access to your money for at least 3 to 10 years. This is the downside of real estate investing in a private equity fund. Number 2, high level of due diligence is needed. These aren't publicly traded investments, so you need to do your own homework and make sure that the investment and the investment sponsor check out and meet your needs. And number 3, accreditation barriers. Only accredited investors have access to the larger or more sophisticated real estate funds. If you do not have the accreditation status, you can focus on crowdfunding platforms, but typically the best deals are going to be with experienced private equity firms, and those are only available to accredited investors. So how do you get started and invest in private equity? Step 1, determine your investment goals. Is it cash flow or is it long-term appreciation? Step 2, decide your entry point. Are you going to focus on smaller crowdfunding platform deals? Are you going to focus on real estate investment trusts or REITs that are traded publicly? Or are you focusing on finding an investment sponsor or partner that you will be investing in their real estate fund or their real estate partnership? Step 3, do your research and vet the investment and vet the sponsor or the general partner. This means looking at their track record from the past, looking at the alignment of interests. Do they have hard skin in the game, cash into the investment? Lastly, are they transparent? Do they frequently communicate with investors and share wins and losses? And lastly, step 4, start small, diversify, and focus on long-term returns. A quote that I really like is play long-term games with long-term people. So when I look at doing a good partnership, I want that partnership to last for decades, not for 1 or 2 years. So you might not want to be concerned about such short-term results. Focus on the long-term picture with your investment capital. Now that you know how to invest in private equity, In this next video, check out how to evaluate private equity deals. Click on the link to watch that next video to analyze properties and investment opportunities like a pro.